First of all, whenever you people are doing your exam, try to go through the requirement of the question, which will be giving you a know-how that what the examiner is actually asking about. Like in this question, the examiner is asking, calculate the expected sale price of the eview clubs and demonstrates its impact on eview cinema company's statement of financial position, forecast, earning per share, and the weighted average cost of capital. 17 marks, and this was the purely numerical calculations. You had to go through the sales price, and this sales price impact you had to show on the financial position, EPS, and the weighted average cost of capital. Now, in the question of the Henwood Shoes Company, which is also your past paper question, the same scenario was there that one division that company was selling, and examiner was asking you people demonstrate that impact upon the statement of financial position, forecast, earning per share, and the gearing. In the same question, like India company, it is available in your past papers. The question named as one question I have told you, Henwood Shoes Company. Henwood Shoes. Other question is the India company. So these two questions also resembles with the question which we are going to attempt in today's class. So then the examiner is asking, evaluate the decision to sell the eview clubs. So the total 25 marks examiner has asked. Now, eview cinemas is a long established chain of cinemas in country of tea. 20 years ago, eview cinemas board decided to convert some of its cinemas into sport gyms known as the eview clubs. The number of eview clubs has expanded since then. eview cinemas company boards brought in outside managers to run the eview clubs, but over the years there have been disagreements between the club managers and the board. The managers have felt that the board has wrongly prioritized investments in and refurbishment of cinemas at the expense of the eview club. So guys, my question from you, whenever the management outside of your company buys your company, what is this known as? Tell me guys. When outside managers they are going to buy your
Manage,
company, what is this?
management by
Buy-ins. Management
management
buy-ins.
buying.
Management buy-in.
Who said management buyout? Tell me. Zenith, is this you said management buyout?
No, I said management buying.
Guys, this is known as management buy-in.
Buy-ins.
When the outside managers are buying your company, when the outside manager
Outside managers.
they are buying your company. And what is the management buyout? When your own
Own
management is
manager
buying
buy.
your company. So this is the difference. First of all, now 5 years ago, eview Cinemas company undertook a major refurbishment of its cinemas, financing this work with various types of debt, including loan notes at a high coupon rate of 10%. Shortly after the work was undertaken, T entered into a recession which adversely affected profitability. The finance cost burden was high, and eview Cinema company was not able to pay dividend for 2 years. So now this is a concerning thing that what is happening, the company is financed by the debt, and upon that debt the company is paying 10% coupon. And what happened? There was a recession in the industry due to which the company profitability is badly affected, and the company has not paid the dividend to its shareholders for the 2 years because the company is having recession. The company's profits may be disturbed. But then the examiner is saying, the recession is now over and eview cinemas company has emerged in a good financial position as two of its competitors went into insolvency during the recession. So its competitors have gone insolvent, but this company is, means that the performance was bad, but still this company is not as much bad as the competitors. eview Cinemas board wishes to expand its chain of cinemas and open new multi-screen cinemas in locations which are available because business were closed down during the recession. So what happened? Now, as the competitors, they have left that business. So the premises or the locations where they had installed that multi-screen cinemas that are available now. And now this company is going to utilize that opportunity. The company is going to invest in that multi-screen cinemas. In 2 years' time, T is due to host a major sports festival. This has encouraged interest in sports and exercise in the country. So what is happening as the major sport festival is going to be there? So as this company, eview Club, they are the gym club, sports gym club. So this is encouragement interest in sport and exercise in the country. As a result, some gym chains are looking to expand and have contacted eview Cinemas company to board to ask if it will be interested in selling EY Club. Now, what is going to happen? Some gym chains, they are now buyers. They are saying to this eview Cinemas that sell us your eview clubs because eview clubs is a gym. So most of the directors regarded the cinemas as the main business and so are respective to selling the eview club. So what is happening? The directors see that the cinemas is their core business. So maybe they will be interested to sell that gym business. So the finance director has recommended that the sale price of the eview clubs based on predicted free cash flows as follows. So you people are lucky that the examiner has given you the free cash flows from year 1 to 4. After year 4, free cash flows should be assumed to increase at 5.2% per annum. Okay. The discount rate, examiner said, used to current weighted average cost of capital, which is 12%. The discount rate to be used to current weighted average cost of capital. Okay. So this is the current weighted average cost of capital, guys, 12%. Remember, in the current, what is happening? We'll see that the finance director believes, now that is very important, that the results of the free cash flow valuation will represent a fair value of the eview club business. Mean whatever the value you will compute with the help of the free cash flows method, that will be value will be a reasonable estimate of the sale price. But eview Cinemas is looking to obtain 25% premium on the fair value as the expected sale price. So for example, by these free cash flow methods, if our price is coming 500, so we are not selling this eview club at 500 because we are requiring the premium as well. So 500 into 125%. What will be the value now? Tell me. Whatever the value is coming, upon that value, you people will be able to sell that because they are requiring a 25% premium.
625.
That is a assumed figure I have taken. Now,
Yeah. Okay.
other information supplied by the finance sector is as follows. Now, this information was there, which was basically very much confusing for the students. But we will solve this question in two ways so that uh, you people will be able to understand this question in a more easy way. Now, the predicted after-tax profit of the eview clubs are 454 million in year 1. This can be assumed to be 40% of total after-tax profits of eview cinemas. So what will happen, guys? Examiner has provided you the predicted after-tax profit of eview clubs. That was 454 million in year 1. And this can be assumed to be 40% of the total after-tax profits of the eview cinema company. So we can find out how much will be the 40% value. But this line was very, very important. The expected sales proceeds which eview cinema company receives from selling the eview club will be used firstly to pay off the 10% loan notes. So whatever the sales proceeds we are having, first that sales proceeds you people are going to utilize with the help of the loan notes. You will pay them. Then part of the remaining amount from the sales proceeds will be then used to enhance liquidity by being held as a part of current assets so that the current ratio increase to 1.5. Those students who are my full-time paid students, you know that the same information was also given in the Hanwood company shoe. The same level, the same
Yes,
information
1.4.
was given. Now what is happening? Examiner has not told you that what will be the current asset figure. Instead of examiner told you people that with the help of the current ratio, we will find out the figure for the current assets. And then examiner said the rest of the remaining amount will be invested in property, plant and equipment. The current net book value of the non-current asset of the EVU clubs to be sold can be assumed to be 3790. Mean the portion, the EVU clubs which we are selling, their value is 3790. The profit on the sale of the review club should be taken directly to reserves. So whatever the sale price will be, we will compute the profit, and that profit examiner said you will be taking directly to the reserves. Now, EView cinema asset beta for the cinemas can be assumed to 0.952. Examiner has told you that what will be the cinemas beta. Because one division you are selling and one division will be remaining. So we have to compute accordingly. Also, in this question, the risk adjusted WACC is also being tested, guys. Okay. Now, eview cinemas currently has 100 million shares in issue. They are currently trading. So we can compute the market value of shares as well. The finance director expects that the share price rise to 10% once the sale has been completed, as she thinks that the stock market perceives it will be a good deal. Okay. Now, trade debt is currently quoted at 96 per 100 for the 10% loan notes and 93 per 100 for the other loan notes. So, in the balance sheet, there are the two long-term liabilities. One is the 10% loan note and what is the other loan note. Now, the value of the other loan note is not expected to change once the sales has been completed. The overall pre-tax cost of debt is currently 9% and can be assumed to fall to 8% when the 10% loans are redeemed. So examiner was very sharp that all the data the examiner has told you. Examiner said when the both debts were present, so their cost of debt was 9%. But now when you people are going to pay off your one loan, so the cost of capital will fall from 9 to 8%. The current tax is 20%. Additional investment in current assets is requiring 7% pre-tax return, and additional investment in property, plant, and equipment expected to earn a 12% pre-tax return. The current risk-free rate is 4% and the market risk is 10%. EView company Sanma's current summarized statement of financial position is shown below. The CEO wants to know the impact the sale on the club would have immediately on the statement of financial position, the impact on the year one forecast earning per share, and on the weighted average cost of capital. So this is the current figures that have been provided by the examiner. You can see in this, there are the two loans. One is the 10% loan, one is the other loan, and one is the bank loan. The three loans are there, guys. Okay. Now, examiner is asking calculate the expected sales price. And then we have to discuss, evaluate whether this decision that as we are selling the eview club, that was worthy or not. So my request to everyone, please open the question in front of you. Hurry up. Everyone should focus and everyone should take participation. Most of the students, those who are the new students like Anju, Ahmed, Barbara, Jay, Caddy, please try to participate. The new students who have joined me in these free sessions, these free sessions are for you guys, please. So, should we start now, guys?
Sure.
Okay. First of all, what was the life of the project which we are selling? Proceeds from the sale. First, examiner has told you the 4 years cash flows were given. 1, 2, 3, 4. Tell me the cash flows. How much are the cash flows, guys?
390, 419,
390,
419,
419,
455,
455,
455, and
and
490.
490. Now, the
Yes.
discount factor was given. How much was the discount factor? 12%.
12%.
Now, apply your spreadsheet functionality and tell me, guys, when you are applying your spreadsheet function, what is the NPV coming? Or the present value from year 1 to 4. Hurry up, apply the spreadsheet function.
One 7.5.
We can say 1318. Then examiner said from year 5 up to perpetuity, our cash flows are growing by a percentage. What was that percentage? What was that?
5.2%.
5.2%. So what is the formula? We will take previous year cash flows. What is the formula? Last year cash flows into 1 plus G divided by cost of capital minus G. And whatever the answer is coming, you will further multiply this answer with last year discount factor. So apply the cash flows are 490. Growth was how much? 5.2. Cost of capital was 12. So 0.12 minus 0.052 and further multiply the year 4 discount factor, that will come as 0.636. So tell me, guys, what is this value coming? Hurry up. Is this coming as 424821? Tell. J, please compute the calculations. Everyone,
Yes.
please.
Yes, correct.
Okay. So this was the present value from year 1 to 4. And then from year 5 to perpetuity, this is coming as 4A to 1. So what is the total coming?
6139.
6139. But we said we will sell at 25% premium.
Yes, sir.
So 6139 multiply by 125%. What is the value coming?
7674.
7674. This is the expected sale price.
Yes.
Any issue, guys? Any issue to anyone?
No.
Clear? Now, guys, eview club we are selling and examiner told you the clubs which we are selling, their non-current assets book value was how much? The book value was given. How much was that? 3790 was given. Tell.
1 second. Book value was 3790. Yeah.
The assets which we are selling, that are how much? 3790.
3790.
And their selling price is how much? 7674. So can you calculate the profit on sale? Yes.
Yes. 3884.
Asset sales prices 7674 and the book value of the assets were 3790.
37990.
So how much is
Three,
the profit on sale?
3884. 3884.
3884. And this profit examiner told you this will be shown in the
Reserve.
result. Everyone clear, guys? Now we have to show the impact on a balance sheet. Try to understand. This is the most important. Guys, tell me what was the current balance sheet? How
Current
much
balance sheet
was
was non-current assets was 15621.
non-current assets?
50.
15621.
Yes, 15621. Current assets was
15
2347.
current assets 43.
2347.
Okay.
2347. Total assets is
2347. Hold on,
yes,
James, hold on. 2347.
yes.
Total was
Total assets 17968.
okay. Then what was your
Then
equity and capitals, equity and liabilities?
called up share up capital was 1000.
1000.
Yes, and retained earnings was 7917.
79.
17.
Okay. Then the total was total equity.
8917.
Now the non-current liabilities.
Then non-current liabilities 10% loan notes.
Yes. How much?
3200. 3200.
Then
Other loan notes. Other loan notes 2700.
then
And the bank loans 985. Total Non-current liabilities are
6885.
6885. Yes, 6885.
What was the
Then
current
current
liability?
liabilities 2166.
And this
Total equity and liabilities are 17968. Total liabilities and equity
17.
968.
So this was the existing scenario. I did not change anything.
Yes, it is.
Existing. Now, understand the point, guys. What is going to happen now? Examiner told you people that whatever the cash flows you people are having, first of all, we will pay off the loan. That was the point. How much is the loan? The 10% loan note. How much was that?
3200.
So it's mean that from the current assets, I will be minusing how much?
32.
3200 I will minus from here, and 3200 I will minus from here. Now, examiner told you that the balance of the proceeds will be invested in the current assets so that your current ratio will be how much?
1.5.
1
5.
So can anyone tell me what will be the final figure here? Tell me, guys. What will be the
Current liability.
revised current assets here? Tell me.
10830.
No. Anyone else, guys?
Current liability times 1.5.
So how much is your current liability?
2166.
2166. See, brother,
Yes.
what is going to happen? How we are going to compute the current asset balance? Apply the current ratio.
Yes. To current liabilities figure.
You know the current ratio formula. It is equal to current ratio is equal to current assets
Current assets over
over
current
current
liabilities.
liabilities. Current ratio
Yes.
examiner told you how much?
1.5. 5.
5. Current assets we have to find out. The current liabilities were how much? 2166.
2166.
2166. So how much this X figure will be?
3249.
This you will place here.
Okay.
Now, what the examiner said then? Examiner said that the balance of the proceeds will be the balance of the proceeds will be there in the non-current assets. What was the examiner said? See, the rest of the remaining amount will be invested in property, plant, and equipment. And the current book value of the non-current assets, this was also given. Let's see now what happens. Guys, can anyone in the class tell me how much will be the balancing figure that will be there in the non-current assets? Tell me.
Can you please repeat what you're asking?
See, again, try to understand. Examiner said to you people, whatever the sales proceeds you will be having, that sales proceeds, first you are going to repay the loan. Then examiner
Yes.
said you are going to have the current assets figure. Then examiner said the balance will be there in the non-current assets. So I am asking how much that balance figure would be. Anyone?
The profit minus
3572.
3349.
How much that?
3572.
How you are computing that 3572, brother? Tell.
The total is sale proceeds is 7674.
Okay.
7674. Out of 7674, we have paid 3200.
Okay.
Okay, and then we have enhanced our current assets to 32, and which is already 2300. So the difference is 902. So we deduct 902 more from the remaining figure.
Well done.
And
Well done, guys. Well done. Now try to understand, guys. See, what is going to happen now? See, our sales proceeds were how much? This figure?
yeah, 7674.
We said that our total sales proceeds are 7674. Out of that, we have paid 3200 for the loan.
Yes.
Okay. Then examiner said to you people that your current assets figure should be 3249. But what it is? Examiner said how much it should be?
3249.
3249. So the
It is
previous
currently
figure was 2347. So how much is
yes,
the difference, guys?
902.
The difference is how much? 902.
902.
It's mean that we have invested in that assets how much?
902.
902. So what is the balancing figure now?
3572.
3572. This figure
Yes.
will be there. We will add in the case of non-current assets. This was the balance sale proceed. And the same question, the same lines were asked by the examiner in the question of the Hanwood company.
Yes.
Any issue, guys?
No, sir. Okay.
So now can you tell me, guys, see, there was an other adjustment in the non-current asset as well. What was that? The non-current assets which we are selling, what was their carrying value? 3790. So this
Yes.
3790 we will also deduct from the non-current assets. So what is the balancing figure now? 15621 minus 3790 plus 3572. How much?
15413.
154.
403.
And now see, guys, here you have taken the 3200 loan, you have minus. You have
Yes.
3200 loan, you have minus. But when you are going to have this proceeds, what will be the entry of this proceed, guys? Cash debit.
Current
By
assets
how much?
debit. Yeah.
You will be debiting the cash as well. By which amount? 76.
7674.
And what are the more entries that should be there? Tell me.
902
902, what should be there? It should be
negative.
negative.
Yes.
What is this equal now? Or still there should be something? Tell.
There should be something. One more adjustment. I'm
That
forgetting.
is this proceeds, which we said the balance will be invested in the non-current assets. Now, tell me the difference between these two figures.
Which two?
2347 minus 3200 plus 7674 minus 902. What is this coming?
Second.
919.
5919.
5919.
19.
And this
Yes.
figure is how much? 3249. So
Yes.
what is the balancing figure now?
2670. 2670.
26. Okay, hold on. Give me 1 minute, guys. Hold on, I have a call. 1 minute, please. This 902 is not here. I am going to tell you why. Hold on. Now, can you tell me what is the difference between these figures? You are having 2347 minus 3200 plus 7674. How much is the balance?
7721.
7721. Brother, again, 2347
Yes. Minus
minus
3200
3200
plus
plus
7674.
how much? 77.
21.
And what is our this balance?
6821.
This is coming 6821, or what is it coming?
It's supposed to be 6821.
6821.
Yes.
Yes.
6821. Yeah. I
Brother,
wrongly. I
this
wrote the
is
3247. Yeah.
6821.
Six.
What was our actual balance? 3249.
3249.
So what is the difference between them?
3572,
This
which
is
we
the
invested
exact
in the.
figure
Yes.
which we
Yes.
had
Yes. Yes.
invested in the non-current assets.
Non-current assets.
So this figure you will deduct from here. 3572. What is happening if I again summarize? Examiner said, whatever your sales proceeds are, you are going to utilize that sales proceeds to pay off the loan. First of all, the sales proceeds entry, you cash debit. Okay. And what will happen? Cash debit. Now, what was our profit, guys? 3884. Raza,
Yes,
3884
sir.
and 3790. Add the two figures. What is the balance coming?
3844 plus. Second figure is
3884 and 3790.
3790. It's 7674.
Now see, what is the double entry for this? Try to understand. Double entry for the sales proceeds. Cash debit
By 7674.
7674.
Yes.
Our non-current assets credit by the book value, which was given.
Yes. 3790.
3790. And
Yes, and
then
reserves
profit
are credit
by reserves. How much?
3884.
3884.
884.
This is the total complete entry. So what we did? We did the cash debit. Yes. Non-current assets credit. Yes. Now under the reserve, you have to show what was the retained earnings. This. So how much was the profit? 3884. That is the first entry we completed. Now, examiner said the balance will be, first of all, whatever the proceeds are, you are going to pay off the loan. We paid off the loan. We deducted the 3200 from here and from the liabilities as well. Then examiner was sharp. Examiner tried to confuse the students. Examiner said now, what is going to happen with the help of the quick ratio, we find out that this is the current assets figure which we are going to place in the balance sheet. This is 3249. Now what is happening? Examiner said the balance will be taken into the non-current assets. So how we are going to compute that balance? See now, 2347 our original. Then we paid off the loan. This was the cash.
All right.
So this should be the figure. This should be the figure. But according to the examiner said this is the figure. So what is the difference in between them? That we will deduct
Investment.
from here and we will add here. That was the point in this question. Understand now? So
Yes, sir.
now see, Raza, net of them, minus 3200 plus 7674
It's
minus 35.
902.
So
It's
the
902.
difference in between these, that is how much?
902.
902. With the 902, your current assets have been increased, and with the 3572, your non-current assets have been increased. Understand?
Yes. Yes.
Now, what will be the share capital, guys? Share capital will remain same.
Yes, sir.
What will be the retained earnings? 11801. Okay. So tell me this figure. How much this is coming? 15403 plus 3249.
18652.
And what is the total share capital?
1 second.
12801.
Yeah.
12801. Yes, it is.
Now, the loan we have paid off. Here it will be 0. Okay. The 2700 we will take as it is. 985 we will take as it is. So our non-current liabilities are how much? 3685.
85. Yes.
And what about our current liabilities? That will be same 2166. So
Yeah, it's
add
tally.
the figures. It is tally.
Yes, it is tally. I'm solving it on
1
Excel at the moment.
8
652.
652. This is the tally. So this
Yes.
was the adjustment, guys. What was the problem in it? Only examiner was sharp. Examiner tried to confuse. Only this figure that you had to find the current assets with this one. And if you know these entries, the cash, then you paid off the loan. This was the original figure. So this should be the balance. But examiner said, no, this is the balance, 3249. So what is the difference? Why it is being decreased? Because the balance is going into the non-current assets. This was examiner said, the balance proceeds will be taken into the non-current assets. Everyone understand, guys?
Yes, sir.
Everyone, please tell me. Understand?
Understood, sir.
Now, if in the exam, you people do not want to think, because in the exam, the time is very short. The time is very short. So there's another mechanism by which you can solve. That is easy method. I am telling you the other method. That will be an easy method when such type of question the examiner says. See now, I am not going to again have the existing balance sheet. I am just going for the revised balance sheet. Okay. Start. What was the current liabilities, Raza?
Current liabilities was 2166.
2166.
Yes.
What will be the non-current liabilities now? The
Non-current
one
liabilities
loan
will
we
be
have paid off.
yes.
There will be other loan
Yes. 2700
and
bank loan
bank loan.
985.
How much are they?
The
2700.
3685 total.
No.
And
Other loan was how much?
2700 and bank loan is
2700.
981. Bank loan is 985.
985. So brother, this total is how much?
3685.
3685.
Yes.
And this is 2166.
Yes.
Now guys, you will state here the equity and liability. What is your share capital, guys? There will be no change. How much? 1000.
1000.
What will be the reserves? In the reserve, there was a change
Yes. 3884 entry.
because profit we are adding. So we will add 3884 in your original figure. That will become 11801.
11801. Yes.
So what is this balance? 12801.
12801. Yes. 12801.
And this and plus all them. So how much is the balance?
18605 652.
1865.
Yes. 18652.
Now see, what will happen on the asset side? There is a formula for the balance sheet. Assets is equal to liabilities. What was the formula? Asset side should be equal to liabilities plus capital. That is the
Capital.
formula. Now, state here the non-current assets. State here the current assets. The current assets figure you will find with the help of the current ratio. What is that coming? 3249.
Yes.
And our balance should be 18651. So what is the balancing figure which will be there in the non-current asset, guys?
15403.
So if in your exam, you people have to save the time, you can go for this easy approach as well. What will happen? Apply this equation, asset is equal to liabilities plus capital, and find the non-current asset figure as a balancing figure.
Okay.
Okay? But
Yes, sir.
remember, now we have to show the impact on the EPS. Guys, are you understanding? Please tell me.
Yes, sir. Totally.
Following.
Anyone, please, any issue?
We are following.
Now, impact on EPS. Guys, what is the formula for the EPS? EPS formula is profit after tax divided by number of shares. So it's mean that, first of all, let's calculate the current EPS and then the revised. And then the
Reverse.
revised. What was the current earnings, guys? What was that?
It's EV clubs was given
454.
4554. Yes.
But examiner said 40% will be there.
This can be assumed to be 40% of total after-tax profit of EV cinemas. So
Okay.
it is 40%. Yeah.
So this is 40% figure.
Yeah, we have to go to
Okay.
100.
So gross up it. Divided by 40, multiply by 100.
1135.
Divided by 40,
40 multiplied by 100.
multiply by 100. How much? Double one.
113535.
Because this was 40% figure.
Yes.
Now, what was your existing number of shares, guys?
Existing number of shares 1 million. 1000 million.
1000.
Yes.
What is the current EPS coming?
1 second. It's 1.135.
Now, what will happen? Try to understand. Guys, in the paragraph, first of all, you said you will be going to pay off the loan. On the loan, you were previously paying the interest. That interest will be saved now. Interest saved. How much was the loan amount which you are having? Tell me. 3,200?
3200. Yes.
And the coupon on that interest was how much? 10%.
10%.
So after tax it, 0.8. So your previous balance was 1135. Now add the savings. How much is the saving? How much?
3200. 32.
Again compute, brother. 3,200 into 10%, that is 320, not 32. Then take 0.8. That is coming as 256. But now remember one more point. This was current. In the current, the both are there. The cinemas
And
plus
EV clubs.
clubs.
EV clubs.
So the current EPS is showing both of them. In the revised EPS, what is going to happen? We have sold the EV clubs. So the EV clubs earnings were how much? 454. So minus earnings for EV clubs. How much that?
454.
454. Now, how much you are going to invest in the current assets?
902.
902.
Yes.
So on the 902, what was the return? Examiner told you 7%
7%.
return.
Yes, 7% return.
So return on current assets.
63.14.
902 into 7% into 0.8. How much?
into 0.8. 50.
51.
50.51. Yeah, you can say 51 round off.
And then return on non-current assets. How
12%.
much was the increase? 3572.
70. Yeah.
And the pre-tax return was how much? 12%.
12%. After tax 80%. 343.
3, 4,
43.
3. So what are your
Yes.
revised earnings comings? 1331. Number of shares will remain same as
1331.
1000.
Yes.
So 1331 divided by 1000. What is the revised EPS coming?
1.331.
So EPS is decreasing.
Increasing.
Understood, guys? Tell. Any issue? Anyone? Now, the last point was we had to show the impact on WACC. Guys, examiner told you people one point. What was that?
For a second, can you please go to the previous sheet for a minute? The
Who is
previous
asking?
working.
Who is asking?
Tembi.
Yes, Thambi.
Please go to the previous working. There's something I want to see.
Are you Thambi?
Yes.
Yes, this one? Or the first
No, no,
one?
no. The one that was there before, just before this one.
This one?
No. We were working the EPS.
This one?
All right. No, no. I got it. I'm in the clear now.
Okay. Now, guys, see, examiner told you that when one division will be sold, so the share price will be increased by. What was that point? It was stated in that question. What is that? The examiner sold the finance director that the share price to rise by 10% once the sale has been completed. So previous price was how much? 15.75. Increase this by 10%. And the number of shares are 1000. So what will be the revised value of equity? Tell me. Revised market value of equity. Previous price was how much? 1.15. Examiner said increase by 10%. So take the 10% of it. What is this coming? Tell.
It's 1.265.
1.265
65.
and the number of shares 1000. So what is the value coming?
1265. 1265.
How much?
1265.
There is something mistake. Number of shares are
Where did you
1000.
take this 1.15 figure?
Oh, 15.75, not
Yes,
1.15.
50.
15.7.
Yes.
So take is 15.75.
15.75. Increasing by 1.1%. It's 17.325.
What was 15.75?
15.75. Yeah.
Now increase this by
10% is 17.325.
17 point.
325.
Now tell me what is the balance?
17,325.
17,325. This is the value of equity. Now, what will be the value of debt? Tell me.
2700 is remaining,
Yes.
but
So the
market value
2700 was given, their market value was how much? 93 per
93.
100.
Yes, yes.
So 93 over 100 multiply by 2700. What is the market value?
2511.
2511.
Yes.
And one was the bank loan. What was the bank loan value?
985.
985. What is the total debt?
3496.
34.
96.
Now we have to calculate the beta that will be applicable for which Nivian, guys?
Cinemas.
Now the beta should be there. That should be the representative of the cinemas,
Cinemas. Yeah.
because eview club has been sold. So
Mm.
examiner made the things easy. Examiner has already provided you the beta assets of the cinemas. What was that?
0.952.
So if this 0.952 has already been given, so apply the equation. Beta asset, that is 0.952. Beta equity, you have to find. Value of equity is 17325 divided by 17325. Value of that is 3496 and 0.80. So what is this beta equity come? 12.
1.10. 1.11.
1.10.
Yeah, 1.11 और 10. राउंड ऑफ कर लें तो 11 हो जाएगा.
1.10, it's okay. Now
Okay.
put this beta equity into the CAPM.
Mhm.
Risk free was given in the question 4%.
Yes. 4%.
Beta equity 1.10. Market return was given as 10%.
15%.
Minus 4%. So the cost of equity is coming how much?
Oh, sorry. Market portfolio was given. It was not market risk premium.
No, not premium. It was just market portfolio.
Okay, 10.6.
So this is coming as 10.6%.
Yes.
Now the things are easy. You have the cost of equity, you have the cost of debt. What was the cost of debt which was given in this question, guys?
8%.
Examiner told you when you will pay off the loan, your cost of debt from 9% it will decrease to 8%. So what was the
Yes.
question, guys? And that it was given as a pre-tax. So we will make it after tax.
Mhm.
10.6% into value of equity. What was that? 17325 divided by total value. Add 17325 plus 3496. How much this is coming?
325 plus 3496. 20821. 20821. 821.
20821. Now, remember, what was the cost of that? 8. But this 8 was pre-tax. Okay. So, into 0.8, then multiply by what was the total value of that? 3496 divided by 20821. So guys, tell me what is the WACC coming?
3496 divided by 20821. The WACC is coming as 9.89.
We can say the 9.9%.
Yeah.
Good question, guys.
Yes, sir.
Any issue, guys? Good
All
question.
good. Yes, sir.
Uh, Zenith, every point clear as you mentioned in the last class, sir, this question. So I look at this and it was really very good question. So any issue?
Yes, sir. I will do this question again.
Okay,
So,
no problem. Now, the theory of this question was very important. That examiner was asking if you have sold this eview cinemas, whether this is beneficial or not. Guys, remember, then the B part. See, what can be there? See, shareholders may question. Shareholder may question. What is the question? That why the company has sold the eview club? Because after selling the company is no longer diversified. Because now the company is only focusing on the cinema business. The other source of revenue, which was the eview club, that has been sold. So the company may be not enjoying the risk diversification benefits. The shareholders may ask it that what is the reason, but you can tell the examiner that although the shares in the CAPM, we assume that the shareholders are already well diversified. So they have already hold a well diversified portfolio. So this thing may be less concern for them. Now, guys, see, in this question, it was stated that sport festival, it was stated in this question that sport festival is going to be there in the country. And this sport festival, definitely it is for the gym as well. Because eview club is also means the gym. In this sport festival, the people, they are interested. So what will happen when the sport festival will be there? So definitely the people will be having the gym membership. What will happen? In the sports festival, the people may be having the gym memberships. So what will happen? In the future, the revenues of the eview club may increase. So shareholders may question that what is the need? Why you are selling? Because they are seeing that if the festival is going to have, there will be many people who are interested to buy the membership and they will be paying you on the monthly basis. So they may question that what is the reason why we are going to sell this at point of time when the festival is coming soon. Now, you know that in this question, this was stated that eview cinema company is going to launch multi-screen cinema. This was stated.
Yes, sir.
So maybe they were of the opinion that whatever the sales proceeds they are getting, from the sale of the eview club, they will be invested that money into the multi-screen cinemas. That may be the reason for the selling, but this investment in the multi-screen cinemas is totally dependent upon the customer's perceptions, upon the customer demand. You know, once you have put on your funds in this project, now according to the NPV basis, you cannot put out them. So before you put your funds here, you should apply the real options. What are the real options? The real options are giving you the choice and the flexibility that instead of start the project now, you should wait for some years, and if the circumstances looks feasible, then you should invest. Understand?
Yes, sir.
Now, very important point. In the first paragraph of the question, it was stated that there was a disagreement.
Okay.
Disagreement between
Just
Managers
one.
and the board.
board of directors and the managers. What was that disagreement? The managers were saying that their eview club has been ignored because the board of directors, they are investing the money in the cinemas. They are not focused in the eview clubs. There was a disagreement going on. So maybe this is the reason that we have sold that to resolve that disagreement. Understand, guys?
Yes, sir.
But then you should tell the examiner what is going to happen. Previously, our WACC was 12%. Now the WACC is at lower level, 9.9%. From the figures, it seems that it is, when the WACC is lower, the market values of the companies are maximum. But what will happen?
Let me just update this.
Now,
Let's update it.
please, Muli, keep muted. Now, what will happen, guys? When now that business is a small business as compared to the previous. Now, to manage the central cost, like previously they were having the overhead expenses, they were being managed by both of the divisions. Now, it is a small business. To manage these central costs may be difficult now. Because now only one department has to fulfill all the expenses. Previously, it was being held by the two. Understanding my points, guys?
Yes, sir.
And the most important point, guys, see now, it was stated in this question that as the sport festival is there, so many buyers are there which are trying to buy the view clubs. It was stated in the question. So the company has seen this opportunity because it is the best time when the company can achieve the maximum price from the buyer. Because when there is a demand and there are many buyers of that, so what will happen? You will definitely sell the item to that person who is paying you the higher price. So the company is utilizing this opportunity. Company do not want to wait this opportunity when the festival will over and the demand will be low. Understand?
Yes, sir.
This was all about your question.